Hello, my name is Steve Bigelow with the Candlestick Forum. The pullback in the market was pretty well indicated by a major candlestick reversal signal. The Dow last week formed a hanging man signal. That was after a hanging man signal, a doji, another hanging man signal, which made this very simple. The trend reversal was likely to occur if they opened things lower the next day, which they did. Closed here, gapped down, and started trading the opposite direction. Produced extremely high probabilities we were going to have a pullback. Same scenario in the NASDAQ. The NASDAQ opened lower after this doji. Then it produced a hanging man type signal. This made the analysis again very simple. We know that if it opens lower after a hanging man signal, that's the bears taking control. What we needed to see was a positive open, telling us the T line was still acting as support. Now we're in a downtrend. Even though we saw some positive trading today, look at your stochastics. The probabilities are that we're still going to see some selling, so the stochastics can get to the oversold area. We are going to be doing some training sessions on when to take profits. Our laser trade, we could see the bearish best friend signal telling you there was a downtrend. But one of the aspects that most people are not taught in investing is everybody's looking for the good trade, but they're never being taught when to take profits. Notice what happened down here. You had a hammer signal, a doji. These are all major reversal signals, followed today by a bullish engulfing signal. When do the probabilities change? When you start seeing reversal signals occurring in the oversold area. This made for a couple different places to take profits. If it opened lower and started trading down, and then came back up through the open, what was the candle color? It was starting to turn green. So essentially you'd be looking at a hammer, a doji, and now potentially another hammer. You could be taking profits here because that's where the probabilities were starting to change, especially here in the oversold area. Worst case scenario, very simple rule. If you see a doji in the oversold area, and it trades back up above the high of that doji, that's where your safety stop should be. That's where you're taking your ultimate profits. So our recommendation on T2, notice when it gapped down, it stayed below the T line, but look at our probability factor. In the oversold area today, we saw a doji inverted hammer type signal. Makes this very simple. Aggressive traders, if it opens positive tomorrow, you start taking profits. Or if it comes back up through the high of that doji, you close out your position and take profits. This is not rocket science. This is just merely doing what investor sentiment does time after time. That's why the Japanese rice traders produce these signals and entry and exit strategies that were extremely high probabilities based upon what human nature normally does. So when you have something as logical as a short on PLL, look at our bearish engulfing right here at the 50, then a gap down through the T line. Told you to stay short. Now we have a doji in the oversold area, right about the same level it bottomed out before. So what's our strategy here? Very simple. Our safety stop is above the doji high because of the doji rule. It's going to move in the direction of how they open after a doji. We have our safety stop there because if it came back up through that level, they're doing a double bottom. But our suspicion is with stochastic still heading lower, you might see it still trade lower, but the safety stop is always good to have in place. So here's when you take profits. We've had a very good trade in INVA. Note how the T line acted as support. Now we have a bearish engulfing signal after a doji, and we have a doji sitting right here on the T line. This is where you use the doji rule. The price will usually move in the direction how they open after a doji. If this opens lower tomorrow, you take profits. If it trades positive, tells you the doji or the T line is still acting as your support level. So we're seeing when to take profits on long positions, and we're seeing when to take profits on short positions. We also can still take advantage of the strong signals. We recommended XAIR today based upon the kicker signal. It opened slightly lower, but as soon as it came back up through this level, what color candle did you have? Another green candle, confirming the bulls were still in control. And here's the rhetorical question we get in the chat room every day. When could we have been anticipating this type of move on Netflix? Where would we have been buying? Well, the answer is, there's your Morningstar signal. There's your bullish candle. There's your bullish candle. There's your bullish candle. You can see the pattern. You can see where it's supported. So you wouldn't necessarily be buying, anticipating this type of move. You'd be buying because it showed the bulls were starting to take control back up above the T line. And this is the rhetorical answer. Do we always get big price moves like this? Definitely not. But candlestick signals and patterns put you in positions where the probabilities of being in big price moves are greatly in your favor. That's the point of the analysis of seeing what investor sentiment is doing, what patterns they're setting up. So the doji rule is still a high probability situation. We recommended going short on PDCE today because of the bearish engulfing, the failure at the T line, and now if it opened lower, trading below this level, that tells you there's looks like a breakdown. Now, if it opens lower again, what do we have? We've got a bearish doji sandwich that's not supporting at this level. Where's your next likely target? Down here. Why is this likely? Because your stochastics are still heading in a downward direction. The T line is a very effective indicator when used in conjunction with candlestick signals. When we see a candlestick sell signal and a close below the T line, we know we can stay short until we see a buy signal and a close back up above the T line. And it also allows us to see much more clearly where the likely target will be that everybody else is watching. So when they failed at the 50, where was the next target? The 200-day moving average. So now it's sitting down here with a doji in the oversold area below the T line. I'm sorry, below the 200. So where's your logical stop loss to take profits? Just above the 200, which is also above the high of today. Again, this is not rocket science. This is just merely analyzing the signals, knowing what should happen after a candlestick signal, and watching what signals form where everybody else is watching. Is this a possible support? Yes, except for the fact that our stochastics are telling us there's still potential more downside. That'll be it. We'll see you in the chat rooms.